Intel has been obliterated this year, that's no surprise. Year to date, they're down 45% and are coming off the heels of another bad quarter where they reported a 15% decline in revenue year over year, along with 60% lower earnings and negative free cash flow. Despite all of this, I just started buying Intel again, and in today's video, I want to explain this move and why I think this could be a great stock to consider for long-term, income-focused investors who are looking for a quality stock at a deep discount. Before we get to that though, in case you're new to the channel, my name is Ryan Williams, and here we strictly talk about dividend stocks and how you can build a portfolio to create a stream of completely passive income that will help you reach financial freedom. So if that's up your alley and if you are on a mission to retire early, then hit that subscribe button. I'd love to stay in touch as we both continue to grow our portfolios and collect that cash flow. Now, as an asterisk to my earlier statement, I think Intel could be a great stock to consider if you have a longer time horizon and don't mind holding the bag for a few years, as this company is currently in the middle of a turnaround and with that is facing a combination of headwinds that are certainly creating some risk. Right now, Intel is facing some stiff competition both on the design front and manufacturing side of things, as well as issues affecting the entire industry like inflation, ongoing supply chain constraints, and a general decline in demand related to macroeconomic factors and fears of a recession. You guys know this story. All of which contributed to the poor numbers we saw coming out of the earnings report a couple weeks ago, which yes, they did beat on the top and the bottom line, that's true, but the most concerning number for us investors at least was the negative free cash flow, which was in the red $6.3 billion just for the quarter, and this had them offering a free cash flow guidance of minus $2 to $4 billion for the year. Now, obviously, this isn't great, seeing as the free cash flow is what a company uses to pay the dividend. This poses a certain risk for us investors who buy these stocks to collect that dividend. At the same time, if you've been following this company at all, then this shouldn't have come as much of a surprise, and in large part, the negative free cash flow is due to a massive increase in capital expenditures for their plans to expand the foundry business and increase manufacturing. Since announcing their IDM 2.0 strategy back in March of last year, Intel has been investing billions of dollars into building out new fabs in places like Arizona and Ohio, as well as places abroad, and simultaneously they've ramped up spending on research and development in an attempt to regain their competitive edge in the industry, which many of us know has been an issue for this company in the recent years. Having said all this, it seems to me that Intel is in a sort of damned if you do, damned if you don't position, excuse my French, where if they don't make these sort of investments right now, they'll continue losing market share, which over the long term would be detrimental to the company. Not to mention, if they don't make these efforts to increase semiconductor manufacturing here on US soil, then it keeps a certain geopolitical risk on the entire industry, which will continue to see increased demand as time goes on. To paint a picture for you, right now, the US only accounts for about 12% of the world's semiconductor manufacturing capacity, putting us behind South Korea, which is home to Samsung, who accounts for 17% of the global market, and Taiwan, home to TSMC, who accounts for 50% of the global market. And as I'm sure you know, there's been some tensions between China and Taiwan, and also between us and China, so increasing our semiconductor manufacturing output is starting to be looked at as a national security issue, and that's why they passed the CHIPS Act, which will grant certain subsidies to Intel and its peers who are investing here at home. Now, on the other hand, in the meantime, while Intel is investing these billions of dollars, it's having a negative impact on their free cash flow, which is causing many people to question the sustainability of the dividend, and rightfully so. When asked about how they plan to juggle all of this, Intel's CFO, David Zinsser, actually had a lot to say on the matter. He said, we expect to manage in the near term while we're in this investment phase to kind of a neutral free cash flow over the course of 2023-2024 combined. Obviously, our long-term goal is to actually significantly improve cash flow, and we still feel like the model we gave at Investor Day is the right model that we can generate 20% free cash flow as a percentage of revenue. And this is over the long term, guys, probably 2025 and after is the timeline here. From here, he went on to say that they actually reduced their CapEx spending for the year to ensure that they weren't going too in over their heads with these investments, and moving forward, they'll take a similar approach to make sure that they're striking the right balance between making the necessary structural adjustments while continuing to provide value for shareholders. In fact, Intel is making it a priority of theirs to reduce spending all across the board in the coming years. Zinsser also touched on this in the earnings call where he said, longer term, we will execute on continued structural cost savings and efficiency gains, which we expect to drive $8 billion to $10 billion in annual savings by the end of 2025. These savings will be realized through multiple initiatives to optimize the business, including portfolio cuts, right sizing of our support organizations, more stringent cost controls in all aspects of our spending, and improve sales and marketing efficiency. And we should see this starting to come to fruition next year, where they anticipate a $3 billion reduction in spending, which will help things in the free cash flow department. Now, obviously, guys, just because they have the intent to make everything happen and do it all, make the right investments and at the same time continue to create value for shareholders with buybacks and the dividend and what have you, does not mean they'll be able to execute on everything, which is the big concern surrounding this company. And there's still a lot of questions that investors are looking for the answers to. Is the dividend safe? Will these big investments pay off? Will the ship be be headed in the right direction by 2025, 2026, which is what they're anticipating. And as many of you know, Intel's not known for their timeliness. And having said that, really only time will tell, and there's a lot riding on how well this company is able to execute on their big plans, and that's why I think this investment is best suited for someone with a longer time horizon who can afford to hold the bag, like I said, and wait to see how all of this plays out. Personally, I'm someone who fits that description. I'm only 29 years old, and realistically, I still have decades before I'm going to be able to live off my dividend income, so I feel like I can afford to take on that risk right now, which I think comes with a lot of upside potential if they can execute, and that's why I started adding more to my Intel position. So taking a look at my Intel position, guys, I have just over 63 shares, and you can see I'm down quite a bit. My average cost per share is $44.29, and like I said, I started buying into this stock recently yet again. In the last couple of weeks, I've picked up almost 10 shares of Intel, which has been nice. I've been able to buy it under $30 per share, which obviously is considerably lower than my average cost, which is one of the reasons I decided to start buying into this stock again. You guys will have heard me say this before, but because the share price is so much lower than my average cost per share, I have a fantastic opportunity to lower this average cost, which in doing so will increase my margin of safety with this position. And with $2,800 invested into Intel, this is not nothing in my portfolio, but at the same time, my position is not large enough yet that I feel like it's putting my portfolio at too much of a risk. Intel only makes up about 4.5% of my total portfolio if we're looking at how it's diversified by weighting, you know, how much is invested. And then taking a look at how it's diversified by income, Intel only makes up about 4.75% of my portfolio's total dividend income. And just based on my comfort level and how I like to diversify my portfolio, I still feel okay adding just a little bit more to this position for now. And I'm happy to buy it at these lower share prices because in the event that things play out how the company expects they will, I'll be better positioned to receive a higher return on my investment. And this doesn't even take dividends into account, which on that note, because Intel's share price has come down so much this year, right? Like 45% year to date, the dividend yield on this stock has never looked better. It's currently sitting just over 5%, which is about 86.5% higher than the company's 5-year average dividend yield. And to sweeten the deal, they also have a pretty long history of paying the dividend. Taking a look at the dividend history page, we see that they've been growing the dividend for the last 8 straight years, which is not too bad, but they've been paying that dividend for the last 3 straight decades, which is unbelievable, which obviously doesn't guarantee that they'll continue paying that dividend for another 3 decades, but does indicate that making these consistent payments is a priority of theirs. And this track record of paying the dividend for so long wouldn't be possible if this company wasn't regularly so profitable. Overall, Seeking Alpha gives them a profitability grade of A+, which you guys know you can't beat that, and the stats are looking pretty good. They have a pretty decent gross profit margin of 46.5%, which isn't bad. This is about 20% lower than the 5-year average, but we covered some of the reasons why that might be. And the net income margin is still looking good, about 20%, which is lower than the 5-year average, but that's going to be for the same reasons we mentioned earlier. Now, I will say the not so great thing is seeing this negative free cash flow margin, which, guys, once again, this is well covered ground between us. We talked about this. I personally feel confident that Intel will get back to becoming free cash flow positive. I can't imagine a scenario where that doesn't happen. But like we talked about, it might take a couple years, which once again, I think makes this a good investment if you're someone who doesn't mind waiting for a little bit. Now, having said that, as far as what's next for Intel, I honestly wouldn't be surprised if the share price stayed pretty stagnant, at least for the next year, the next couple of years. I don't imagine they'll see too much capital appreciation. But if you have that longer time horizon, this is fine because I think based on some of the valuation metrics, this is creating a really good buying opportunity right now. If we take a look at the intrinsic value for Intel from alphaspread.com, which is an awesome website, I highly recommend you guys check it out. They give a base case intrinsic value for Intel of $34.50, which would mean that it's still undervalued by about 15%. Best case for Intel, you know, things work out and then some. They give it an intrinsic value of about $57, which would mean that today it's undervalued by nearly 50%, a lot of upside. But then worst case scenario, guys, let's say things don't work out for Intel. They give it an intrinsic value of $23.83, which means that today, where it's at now, just under $30 per share, it's still overvalued by nearly 20%. Having said that though, guys, the price to book for Intel right now looks pretty dang appetizing. It's currently sitting at 1.2, which is 69.35% lower than the sector median, so definitely a discount there. And it's also over 50% lower than the 5-year average, so, you know, which is no surprise seeing how much the share price is down this year. And with that, I'm also going to continue adding shares of this next stock, which I'll tell you all about in this video right over here. Like Intel, this stock is one of my portfolio's worst performers, and because of that, its dividend yield is being pushed up astronomically high to over 7%. So check it out right here, and I'll see you in the next one.